If you need cash and you're staring at your brokerage account, this feels like a simple choice. Sell stocks or borrow and keep investing. But it's not really a market question. It's a cash flow question, a tax question, and a risk question. And right now, borrowing is not cheap by default. The Federal Reserve's latest data showed the average rate on a 24-month personal loan at commercial banks at 11.40% in February 2026, while the bank prime rate was 6.75% in early April, which matters because a lot of variable rate credit is priced off prime. Here's the cleanest way to think about it. Selling stock creates a known tax event. Borrowing creates a known payment. What people get wrong is assuming the stock market will somehow cover the interest later. Maybe it will, maybe it won't. Your loan cost is real and scheduled. Your portfolio return is uncertain. So the first question is not, which option keeps my investments growing? The first question is, what is the cheapest and least risky way to solve this cash need without creating a second problem? If the money is in a regular taxable brokerage account, selling is often simpler than people think. The IRS says gains are long-term if you held the asset for more than 1 year, and short-term if you held it 1 year or less. Long-term capital gains usually face lower federal tax rates, generally 0%, 15%, or 20%, while short-term gains are taxed like ordinary income. And if you have capital losses, they can offset gains with up to $3,000 of excess losses, potentially reducing ordinary income in a year. That means the tax hit from selling may be smaller or larger than your gut tells you, so you need to actually run the numbers. Borrowing can make sense, but only in a narrow set of cases. If you have a short-term cash need, a clear repayment source, and a fixed rate loan with a manageable monthly payment, then preserving your investments can be reasonable. But when you compare loan offers, the CFPB says to look at the APR, whether it can change, and the fees around the loan, not just the teaser rate. That matters, because a loan that looks acceptable on the surface can get much more expensive once you include origination fees, annual fees, or a variable rate that resets higher. What I would not treat as a casual solution is borrowing against your portfolio. Securities-backed lines of credit and margin loans sound elegant because you avoid selling, but regulators have been warning about the same problem for years. If your investments fall, you can get a maintenance call, be forced to add collateral, or have securities sold out from under you. The SEC notes that these lines can trigger unintended tax consequences and force sales, and FINRA's margin disclosure is blunt that firms can liquidate assets without contacting you first, and that you can even lose more than you originally deposited in a margin account. That is a bad setup for an ordinary household expense. The other option people reach for is retirement money, and that comes with its own rules. The IRS says IRAs cannot make loans at all. Some workplace plans, like a 401k, may allow loans, usually up to the lesser of $50,000 or 50% of your vested balance, and repayment generally has to happen within 5 years, unless it is for a principal residence. But if you leave your job or fail to repay on schedule, the unpaid amount can become a taxable distribution. And you may also owe an extra 10% tax if you do not qualify for an exception. So, yes, a 401k loan exists, but it is not free money and it is definitely not frictionless. So here is the practical rule. If the expense is a one-time need and you do not have a strong near-term repayment plan, selling is often the more honest answer. If the expense is temporary, and you truly have the cash flow to wipe out the debt quickly, then a reasonable fixed rate loan may be fine. And if the loan is variable, tied to volatile collateral or dependent on you keeping a job or a rising market, the risk usually outweighs the convenience. In plain English, the more fragile the repayment plan, the less attractive borrowing becomes. Picture two examples. If you need cash for a vacation, a wedding upgrade, or to cover a lifestyle gap, taking out debt while keeping stocks is usually just a way to avoid admitting you are spending investment money. Selling is cleaner. But if you need cash for a tax bill due this month and a bonus hits next quarter, a short-term loan could be reasonable if the all-in borrowing cost is low and the repayment is basically already spoken for. Same decision, different cash flow reality. So, sell stocks or take out a loan. In most everyday cases, sell if the tax cost is acceptable and the borrowing cost or collateral risk is not. Borrow only when the repayment path is clear, the terms are controlled, and you are not putting your portfolio or retirement plan in a position where a bad month turns into a forced mistake. The right answer is usually the one that reduces complexity, not the one that sounds more sophisticated